Today with an analysis report on Nauticus Robotics, ticker Kitt. It's arguing for a perfect dip buy opportunity after that huge 25% stock crash.
Yeah, and the whole thesis is really built on the idea that Transocean, the big institutional seller, is finally done liquidating their shares.
Exactly.
It's a compelling hook, I'll give it that. The research into that specific selling pressure is genuinely strong. It's a great foundation.
Okay, so let's start with how the report handles the downside. All of the big risks are pushed to the very end in Section 4, which is literally titled Critical Risks, the Fine Print.
Mm-hmm.
It lists the cash burn, which is about, $6.6 million in Q3, that massive $250 million equity line, and the whole fight to stay listed on NASDAQ. It just feels separate.
It is. And that's the first major issue. The segregation of the critical risks into a distinct final section diminishes the analytical rigor and compromises the objectivity of the report.
Why is that so bad, though? I mean, isn't it kind of standard to lay out your case and then list the risks?
For a regulatory filing, maybe, but not for an analysis making an aggressive call for an immediate dip buy. The weakness here is that framing them as the fine print, well, it suggests they're secondary.
Right, like something you can check later?
Exactly. But these aren't secondary concerns. Dilution from that massive equity line, the delisting risk. I mean, these are fundamental, high-probability threats that directly contradict the bullish urgency of the first three sections. You can't just silo risks that are that existential.
That makes a lot of sense. So if they're fundamental to the whole trade, they need to be part of the setup itself.
Precisely. The report should integrate the critical risks directly into the bull case narrative, into the trade setup itself. You have to use them as variables to stress test your own catalysts, not just list them as, a formality.
Okay, so how do you do that? How do you actually weave something like the dilution risk into the price targets?
Well, the key suggestion here is to tackle that dilution risk right after you define the targets. So the report says target 1 is 135, target 2 is 155.
Yeah, based on the technical gap fill.
Right. But the analyst needs to treat management's ability to tap that equity line not as some hypothetical risk, but as a guaranteed feature of the landscape right now.
So you're saying you turn the risk into a predictive part of the model?
Yes. If the stock actually hits that target 2 of 155, the analysis has to pivot and ask, okay, at what price is management, who are burning $6.5 million a quarter, most likely to dilute?
And that would cap the upside.
It would absolutely affect the upside. The report needs to model how that dilution could just evaporate that 20% gain that the technicals are promising.
So give me a concrete example of what that would look like in the report.
Sure. The analysis could explicitly state something like, look, should the stock hit $1.50, we anticipate significant dilution risk. This action could immediately neutralize the technical upside, potentially pushing the price right back down to the 130 level.
Okay.
See, that transforms the risk from fine print into a mandatory part of your exit strategy. You're setting an integrated risk-adjusted price target that's probably lower, but it's way more realistic.
I like that. It shows you're thinking about management's next move, which is critical with these small companies. Okay, so that's integrating risk. Now let's look at the setup itself. The report calls this a high-risk, high-reward swing trade.
Mm-hmm.
And the bull case rests on these immediate technicals. It's extremely oversold, there's that gap fill target, but then it brings in the whole commercial pivot 2026 story. Aquanauts, Toolkit software, that's years away.
And that's the second core issue. The report's reliance on both immediate technical triggers and those future-oriented fundamentals, it really muddies the core thesis about the time horizon.
I see your point, but aren't you worried that if you take out that 2026 story, the whole thing just looks like a blind momentum trade? Like it has no foundation?
That's a valid concern. But the issue isn't the research, it's how it's aligned with the purpose. The analysis sets up a really clear short-term catalyst, right? Transocean is done selling, so we might get a 10 to 20% rebound.
A dead cat bounce, basically.
A classic dead cat bounce. A trade for a few days, maybe a week.
A very tight window.
Exactly. And then you throw in 2026 guidance and a pivot to high-margin software. I mean, those are multi-year growth factors. For an aggressive swing trade, they're basically irrelevant. It just dilutes the focus.
Okay, so let's say the analyst feels that 2026 story is critical to the company's value. How do you reframe it so it actually supports the short-term trade instead of confusing it?
The suggestion is to clearly delineate its purpose. If this is a swing trade, you have to explicitly state how that 2026 outlook acts as a hard, near-term psychological floor that stops a deeper collapse. It's not an upside factor. It's a defense mechanism for your entry point.
So connect the distant future to the immediate problem. How would that look in practice?
Well, you connect the 2026 story directly to the company's most urgent fight right now, which is staying above $1 and avoiding delisting from the Nasdaq.
Okay.
So instead of just talking about it as some future growth story, you reframe it. You argue that the only reason that $1 psychological support will hold is because the market can see this viable, however distant, path to real revenue.
That's a really powerful shift. So the 2026 data isn't just upside fluff, it's the structural defender of your entry zone.
Exactly. It ties the deep research directly to the actionable trade. And it stops asking the reader to hold two completely different time horizons in their head at the same time.
Let's shift to the third key area then, calibrating the risk versus the reward. This is make or break for any dip buy, especially one called perfect. The numbers are laid out clearly. Your entry is 110 to 120. Target 2 is 155, so maybe 20-25% upside. But then there's the downside. Stop loss is $1. But if that breaks, the report says the next floor is the 52-week low, around 71 cents. That is a steep drop.
It is. And the analysis presents a risk-reward profile that is just insufficiently calibrated, given that the potential catastrophic downside significantly outweighs the short-term upside.
Can you walk me through the math there that makes it feel so lopsided?
Certainly. Let's say you get in at the top of the range, 120. Your maximum technical upside to 155 is about 29%. That's attractive, sure.
Okay.
However, the report itself says if the 95-cent stop loss breaks, the next floor is 71 cents. From a 120 entry, that's a potential 41% loss.
Wow.
So you're looking at a 41% risk for a 29% reward. That ratio completely undermines the idea of a perfect dip buy opportunity.
Right. Most traders want at least a 2-to-1 ratio in their favor, not the other way around.
Exactly. The report needs to spend less time on the gap fill upside and way more time rigorously justifying why that dollar floor is going to hold. The title itself is challenged by how bad the downside is if you're wrong.
So the analyst has to convince us that the 71-cent floor is a really remote possibility. How do they strengthen the argument for that $1 level?
The suggestion is to bolster the discussion around Transocean's liquidation. You have to take that data and integrate it directly into the defense of that floor.
So it's a narrative change mainly?
It's a narrative change that uses the report's best data. It already did the great work of quantifying that selling pressure. Over 2 million shares dumped on the market.
Right.
The improvement is to explicitly connect the removal of that specific overhang to the strength of the $1 support level.
So you're framing the $1 floor as not just psychological, but as a technically robust barrier now.
Precisely. The concrete example is to frame it as a barrier that is now defended by the complete capitulation of the single largest seller. By linking the downside defense to your strongest piece of data, the Transocean exit, you make a much more compelling case that a breakdown to 71 cents is no longer a high-probability event.
That really does change the conviction.
It does. You have to communicate. The reason we believe $1 holds isn't hope. It's because the one single pressure that drove us down here is now gone. That fixes the lopsided risk profile.
It feels like the main theme here is moving from a speculative pitch to a fully integrated risk-tested analysis.
That's the core shift this needs. Overall, the thesis is clear and the initial research on Transocean is exceptionally strong. That is the anchor for the whole thing.
So, to wrap it up, 3 main refinements. First, integrate the critical risks. Move cash burn and dilution out of the fine print and use them to adjust your exit targets.
Yep.
Second, clarify the time horizon. Eliminate that friction between the short-term trade and the 2026 fundamentals. If you keep the 2026 story, make it the defender of the $1 floor.
And finally, rigorously calibrate that risk-reward. Use the Transocean data to really hammer home why that dollar support is a brick wall and the 71-cent downside is a remote possibility.